age, if these parameters show further improvement, you need to pay further less on this matter. Whether a hospitalization arises or happens is a secondary matter. But if you have done the necessary actions to prevent many of the other unexpected issues, obviously the premium should reduce over the years. Do we think in that line? Do we think that there is a possibility that such a product can be developed in various modules over the years, 30 to 40, let us say? This has been your record. 40 onwards, this has been your record. How many times you have been hospitalized. If there is an accident or something, that's a separate matter. Second, we are definitely heading towards a time of real-time claim approvals. No paperwork, no waiting rooms, no TPA calls. You walk into a hospital, scan your QR code, and the insurer gives you instant approval using AI-based medical validation. Straight and simple. Treatment starts immediately because health should not wait for the files to move. This is basically the understanding that health payment of claims need not move in tandem with movement of files. If you have paid the premium over the years, when you are hospitalized, the treatment should be seamless, the payment should be seamless, and claim settlement hassle-free. The regulator will be working towards it, and to see that a major cause of concern and major cause of policyholders' distress need to go. It may be a gradual process, but this will happen. I can assure you that. Third, there is a huge potential for personalized coverage modules. Instead of buying one big policy, imagine building your own cover, like what we call as Lego blocks. Mental health, maternity, dental, cancer prevention, or sports injury. All add-on modules priced on your specific life stages, your own risk profile, your own interest in pursuing various activities. Students, young professionals can pay only for what truly matters to them. Fourth, we expect to see very soon predictive health alerts. Your insurer uses anonymized medical and lifestyle data to warn you 6 to 12 months ahead before a health risk becomes a serious concern, whether it is diabetes, stress burnout, or cholesterol spikes, and even offers subsidized checkups or teleconsultations. In such cases, prevention becomes the new claim settlement. You keep alerting your policyholders to the risks and to the areas that he is getting into. Finally, the future could bring outcome-based insurance. When we say that, we mean today we pay for a treatment. Tomorrow we will pay for the results. For example, if you join a weight loss or diabetes reversal program, the insurer subsidizes it. And if your health indicators improve, your premiums drop instantly. Insurance and wellness become totally in one ecosystem. So insurance is not a single standout product. It encompasses wellness along with it with the help of the insurer. These ideas, which we have now started seeing with many startups and many other entrepreneurial people who are coming and showcasing us their things are in due course going to come and be part of the insurance company sooner than later. And they also reflect that health insurance is not a product you buy once a year, but it is a living, intelligent system that grows with you, protects you, and rewards you, and keeps you healthy. And for young people like you who are sitting backside, this is the most exciting time to shape the future. From health, let us now come to motor. Motor is also on the verge of a major transformation. Not the old repair and reimbursement model anymore. We are talking about innovations that could redefine how all of us experience mobility and safety in the coming decade. Let me share a few next-gen ideas that have started to take shape gradually. First, imagine the behavior-based premiums, as Madam has already alluded to. Your premium changes in real time, depending on how you drive. Smooth braking, steady speeds, no hard acceleration, your premium will drop automatically. Rash driving, inviting challans, the system nudges you with alerts and makes every driver responsible subsequently. And you will be rewarded for your good behavior on the road, for following traffic signals. It is easier said than done. There are some cities where the traffic signal has no meaning. But in due course, we have to inculcate such good driving sense people. Whenever you see people driving in a, suddenly getting into the highway in a high performance car, suddenly they feel that they must driving and they must test the engine's responsiveness and everything. The vehicles are made for certain things, for certain mobility. It is not to test your own driving capability or your own mindset to become a rally driver on a highway. It's not for that. Second, future motor policies definitely likely to include AI accident detection and instant cashless approvals. We have now seen a lot of motor cars on the road in Indian context which are ADAS level 2 adaptive. ADAS has gone to level 5. We are at ADAS level 2. We are not going beyond that. We are not prepared infrastructure-wise and otherwise, and from a driving sense of point, we are not developed to that extent. ADAS level 2 itself is very difficult for people to adjust. But these things will gradually seep into the policy. What kind of vehicle you are driving, how capable is that vehicle to detect the forthcoming accident, or how you are alert towards this response from the engine. The moment a collision happens, your vehicle sensors send data to the insurer. Within seconds, the AI verifies the impact, approves the claim, and dispatches a tow truck to repair the team. No long calls, no paperwork, no service. Insurance literally arrives before you call for help. It is linked. Your vehicle and its system and its software is linked to the insurance company. Any moment, if it is stolen or if it is met with an accident or anything, or you are stranded, the information is available real time at the insurance company. Third, we might see modular driving packs. Instead of a one-size policy, you choose packs like city driving. Only city driving, 60% of time, 40% on highway or in some areas. Long distance highway driving, You need a protection for that, that is different. A ride share cover, college campus protection, or even a special cover for weekend adventures. You have a 4x4 all-wheel drive car, which is designed for specific terrain driving. You need a special package. Take that. It is not meant for your city driving or city parking and certain other things. It will undergo different kind of mechanical failures, if at all it happens. You pay only for your actual lifestyle and your driving patterns. How do you drive? Now the fourth and another interesting part. The industry could launch soon predictive maintenance insurance. Using vehicle telemetry, insurers can warn you weeks before a major breakdown. You will be warned about a breakdown, that this part of your vehicle is worn out. Your brake pedals need replacement. Your clutch pedal is not up to mark. If you are driving automatic, that's a different issue. Then, are you expecting a battery failure, brake wear, tire risk, engine health? These are all possibilities, and these are coming. If you are thinking that we will continue with the same age-old motor policies, give for this with some add-ons, those days will go. You act early by getting the predictive maintenance alerts. Your deductible will reduce. In totality, what is aimed at is prevention becomes part of your insurance experience. It's not that I will do everything. When the vehicle breaks down, the insurer will come. Fifth, and another most interesting part is the growth of EVs in India. Now, imagine that you have an EV and you have battery health coverage. That is the engine for the EV. Not just damage cover, this would include battery degradation prediction, charging pattern optimization, free fast charging credits, and guaranteed replacement at certain health levels. The battery is the new engine, and insurance has to evolve for that future. That vehicle is different from the conventional vehicle. Let us accept that fact. It provides you mobility, but its engineering, its mechanics, and its driving dynamics are different. And its engine problems are different. Finally, the most exciting idea is an interesting thing. It is shared mobility coverage. What does it tell? Students often use multiple modes. They use bikes, they use car rentals, ride shares, metros. A future policy could insure you as a driver and a rider, both, across all modes, and not just one vehicle. If you drive, ride, rent, or share, it's all covered under one identity-based policy. In effect, it will give you a freedom of mobility policy. You want to drive, drive. You want to ride, ride. You want to share your mobility, you can share different packages, different modules in a single policy. Now, these innovations in two of the major areas, that is health and motor, it shows us a future where motor insurance also isn't about paperwork and premiums. It's about safety, intelligence, personalization, and seamless mobility. And young people who are there inside the room, they are the ones who will be shaping such products in the days ahead. The third and another important factor is with which the policymakers are also grappling, and a lot of time, lot of resources are devoted towards this. That is climate risk. Climate risks and parametric insurance are very closely related. Globally, parametric solutions are gaining traction and India too has begun to embrace them. In India, for example, the northeastern state of Nagaland has renewed a 3-year parametric policy covering floods, landslides and drought, with participation by state government, insurers and reinsurers. Climate risk covers the need tailored solutions, parametric triggers, index-based cover, government insurer collaboration and subsidies for vulnerable sections. As has been alluded to earlier by speakers, the protection gap is large and in advanced markets, without this gap being covered, the innovation, the gap will definitely widen in future. And product design must consider affordability, speed of payout, transparent triggers, and be aligned with development priorities, resilience and livelihoods. For India, this implies to meet the national ambition and regulatory goals, we must reimagine climate risk covers, move beyond the standard property, fire, flood covers to scalable parametric index covers, agricultural catastrophic insurance, urban flood covers, infrastructure resilience covers. We must realign them accessible to the large population, affordable, distributed through digital channels, and linked to national resilience programs. The fourth subject which I talked about earlier is cyber. Cyber insurance is emerging, though it is nascent. From a risk perspective, cyber threats are intensifying and India is not spared of this. In fact, it is ranked second in ransomware volume globally. In foreign jurisdictions, there is a huge global market. Solutions are more mature with cyber insurance embedded in corporate risk frameworks. Many jurisdictions pair cyber insurance with cyber risk advisory services, continuous monitoring, and integration with broader enterprise risk management. Now, what does this imply for product innovation in India? When you reimagine, a cyber risk products need to be accessible to the vast SME segment, this country, even digital savvy individuals, not just large corporates alone. They must reflect Indian threat landscape and within a mobile fast UPI digital payment supply chain and digital identity ecosystem, the threat perception is very high, and when you realign this, the product needs to be intelligent, affordable, simple, and possibly modular and distributed through various digital channels. Underwriting must leverage the data, monitoring tools, partnership with cybersecurity firms. And from regulatory and national perspective, as India digitalizes further, systemic cyber protection via insurance supports national digital resilience. Cyber insurance is a prime example of product innovation aligned with national priorities and evolving customer need. For the vast population of this country, when we are talking about insurance for all and in 2047, one of the key questions for India is, given the size of the population and significant coverage gaps in insurance, can package products help serve a huge proportion of the population? I believe that the answer is yes, but again, when the regulatory mind starts working, it will come with caveats. Large population with diverse needs and often low insurance penetration means that traditional high-touch, high-premium customized products exclude many. Package covers, which are simple accident covers plus wellness benefit, health cover and teleconsultation, allow scale and cost efficiency. Embedded insurance from the insurance offered seamlessly from the point of transaction is growing. For India, embedded insurance offers a channel to reach vast underserved segments. We have talked mostly about non-life products, but I also strongly believe that life insurance products also need innovation. Let us look at it from two regulators' point of view. If you are having an NPS product overall, and you are looking at pension overall after the age of 60 or something, two regulators come into picture. Your accumulation phase under PFRDA, your distribution phase, the annuity phase under IRDAI. Have you separated both the funds and seen what is the return? If I put my money continuously over a period of time for 60 years, maybe whether it is equity index based or equity plus debt or debt alone, what is the rate of rate of return that I get up to 60? Once I hand it over to the annuity, what is the rate of return that I'm getting? It is hugely different. Sometimes some of the life products, even in par, non-par, if you look at them closely, there are products where the IRR is 0. Whether it will be questioned in course or not, or putting money over so many years, and at the end, when you buy the annuity, it is 60% is what goes to annuity and 40% is what is given. Now it is again going back to some 40-20-20 kind of breakdown. Will not a young person ask that question, that need I buy an annuity at this point? Now, who is attracting more funds then? Is the long-term product from the annuity point of view, though it should not be directly looked into the point of view of what is the rate of return, but it will come to question that whether this is justified. Then if we don't innovate the product to that extent and say that for the cost of giving you a guaranteed cash flow or guaranteed payment, I charge you this much over the years, the justification for that will come to the question by the person who is at the receiving end. If he simply puts a calculation over PPF and equity and says that I will manage my pension from this, can we say that from the point of view of IRR, simply from IRR point of view, he is not justified? Though it is difficult, I'm not saying that is easy, it is easier said than done, but when you look into over a long period of payment of premiums and the annuity subsequently coming to that, and you say vis-a-vis what is the return that I have got, then people will one day question you. They have started questioning also. And there will be a lot of reforms that is coming in the pension sector also. So we must not close our eyes to what is happening to our long-term products, to what extent they are beneficial to the people who are interested in buying them, and what should be the combination for them. And as Mr. Patnaik told beforehand, 61st month persistency is at 48 to 49%. What does that mean? Are we saying that if you buy a 20-year policy want to put money for 20 years and after 5-6 years find that 50% of people are gone. Need you pay a renewal commission for that? Or you should pay commission only when the persistence level is at X level? Why should I pay commission in the first year or in the second year? What the intermediary has done? I buy a life insurance policy for 20 years. I am paying digital, let us say after first year. My payments are digital. Almost all young people will be paying digitally. Need you pay commission to that extent? At the cost of the policy holder, the bottom line is policy holder first, shareholder next. And if the policy holder doesn't stand to benefit, it is his money which is going through, then for what purpose we devise and we innovate and we sell our products? Over a long-term period, if you look into the capital markets across financial products, you have now n number of products. Indians can invest overseas. Indians can invest elsewhere. You want to attract funds to your sector, wants to increase. The total AUM is now coming to something from investment point of view. In the insurance industry, something close to now 75 lakh crores, 5-6 times bigger than the pension funds this point of time. In due course, they will catch up. If we don't rethink and realign our products to the growing demands, if we remain anchored to the same age-old policies that we have been selling and keep selling, that will not sell in the future. Don't sell. That is the stark reality. That is why from the regulatory point of view, we do see a lot of changes that are happening across various regulators, across various financial products, across the capital market. So many times you would have seen the SEBI alerting individuals regarding derivative markets. There is a reason. Careful. When you come to capital market, you always hear a third and somehow, I have no idea. I mean, fair enough. But these are emerging things which we must remain alert to. When we talk of risk, we should always look behind also and to see that we haven't left anything on the trail that might come back to hurt me. Anyways, jokes apart, my sole point of alerting all of you is that you need to remain open to the challenges that is coming. It is not a time to sit back and be complacent. I started this discussion with saying that it is boring, but I can assure you that the industry will be very exciting in the days ahead. Thank you.